Part 1: Why the dollar drops even when rates are high. The news keeps shouting that the dollar is crashing, but nobody explains why it's happening when U.S. interest rates are so high. People think higher rates mean a stronger dollar. That's true in textbooks. Here's how it works on paper. Let's say you've got $1 million to park somewhere safe. A U.S. bank offers you a 5% interest rate. A European bank offers only 2%. Which one do you choose? Most people would choose the U.S. 5% on $1 million means $50,000 a year in interest. 2% means only $20,000. So it looks like a no-brainer. That's why, in normal times, people exchange euros for dollars to put their money in American banks. More people buying dollars makes the dollar go up in value. So far that's simple. But reality doesn't always follow the script. Right now, U.S. rates are double those in Europe. Yet, the dollar has dropped around. It doesn't add up at first glance. Why would investors walk away from bigger returns in America? Let's look deeper. Imagine you've got that same $1 million. You want it safe, but you're hearing that some U.S. banks might collapse, or that the U.S. government could shut down because of debt fights in Congress, or that big investors like Buffett and Dalio are warning about the dollar's future. Even if you'd earn $50,000 in interest in the U.S., you might still decide it's not worth the risk. That's the problem. People fear losing their money more than missing out on a few extra percent in interest. So they'd rather take $20,000 in Europe than risk trouble in the U.S. It's not about pure math. It's about fear. This is why the dollar is weaker even when U.S. interest rates are high. But here's where it gets strange. If everyone is running away from the dollar, why aren't European interest rates dropping because so much money is flowing in? The money isn't going there. So where is it going? If the dollar is falling but Wall Street is Part 2: Fear vs. Yield. Why money flees America. People talk a lot about chasing higher interest rates, but big investors often care more about safety than yield. Banks collapsing scare them. Political fights in Congress scare them. Headlines about the U.S. debt scare them. It's not just regular people feeling nervous. Buffett is cautious. Ray Dalio is warning about the dollar. Big names like Goldman Sachs and Citibank have talked about trouble for the dollar. That makes foreign investors uneasy. It's not just about earning $50,000 on $1 million. It's about making sure the million doesn't disappear. After the 2008 crisis, investors learned a hard lesson. High returns mean nothing if your bank fails or your currency drops. Back then, even solid American banks wobbled. People lost trust overnight. So today, investors look at the U.S. and wonder, could something similar happen again? They see high interest rates but also big risks. So they choose. Even if Europe pays only $20,000 on $1 million, it feels calmer. They'd rather sleep at night than chase higher yields. This is why money sometimes leaves America, even when it doesn't make sense mathematically. But that's only part of the story. If money is fleeing U.S. bonds, why isn't it flooding European bonds instead? Why are European bonds still cheap? Why is nobody buying them up? If investors are afraid of America, shouldn't they rush into European debt? But they don't. So where does the money go instead? If it's not in bonds, is it hiding somewhere else? Or is it looking for bigger profits in new places? This question matters for every investor trying to stay ahead. If the safest assets in Europe are still ignored, something bigger is happening. So why doesn't the same cash flow? Part 3: The European Puzzle. Stocks vs. Bonds. People might think all the money leaving U.S. bonds should go into European bonds. But that's not what happens. European bonds are still stuck. They are not shooting up in price. Yields in Europe remain low, but bonds don't attract waves of new cash. So the question is simple. Where's the money going instead? It's moving into European stocks. Investors want growth. They want places where they believe they can earn more. The numbers show it. From the start of the year, stock markets in France, Germany, and even the UK have climbed. Not always fast, but enough to make investors feel there's a new opportunity. Money that once sat in safe government bonds is now shifting into riskier shares. The same pattern shows up in Hong Kong. Hong Kong stocks were crushed for years. People called the market toxic. But this year, the index jumped about 30%. Why? Because money came back in. They don't care only about news headlines. They watch where other investors put cash. Once money starts moving into stocks, prices can climb fast. Europe is seeing this now. Even if Europe's economy has problems, investors bet on momentum. They hope they'll sell to someone else at a higher price later. But that leaves one big question. If European stocks are rising, why isn't the same happening immediately in America? Why aren't US stocks soaking up all the spare cash right away? Something is holding money back. Investors are cautious. They are waiting for clarity. They are trying to read the signals. Because if Wall Street jumps in too early, it could get burned. And nobody wants to be the one left holding stocks if the market tanks. So why doesn't the same cash flow into part for smoke and mirrors, the dollar trap? It looks like the dollar is crashing because money is leaving America. But that's not the full truth. The drop in the dollar is partly on purpose. It's a trick to keep foreign money stuck inside the US. Think about it this way. Imagine you're holding hundreds of billions of dollars worth of American investments. If the dollar drops 10%, your investment loses value. If you try to sell and convert back to your home currency, you lock in that loss. So you wait. You hope the dollar recovers. And that's how your money stays trapped. It's cheaper for the US to let the dollar fall a bit than to watch foreign investors pull out trillions. A small drop blocks a giant exit. The transcript talked about Taiwan as an example. In 2 days, only $8 billion flowing out made the dollar drop 10%. But Taiwan still has around $600 billion stuck. They can't sell all of it without crushing the dollar even further. So they wait. The same happens with Europe. Europe might move $30 billion, and it shakes the currency markets. But Europe holds over $1 trillion in US investments. If they tried to pull it all out, they'd hurt themselves. So they stay put. This is how America uses a small amount of money to lock up a much larger sum. It's like putting a chain on the vault door. A little pressure keeps the cash inside. Think about the North American housing market. If home prices drop 10%, many owners don't sell. They wait for prices to come back. They don't want to take a loss. The same thinking applies to big investors holding dollars. They'd rather wait than cash out at a loss. So the dollar's drop looks like weakness. But it's part of a bigger strategy. America sacrifices a little to protect a lot. And while everyone watches the dollar fall, the real who's still part 5 Wall Street's secret, leverage keeps markets afloat. Money is still moving into US markets, but not the way people expect. Wall Street is using leverage. Leverage means borrowing money to make bigger bets. Let's say you have $1 million. You borrow $9 million more. Now you can invest $10 million instead of 1. Your profits grow faster, but your risks grow too. This is how big banks keep the US market alive. Even when foreign investors hold back, Wall Street steps in. The The transcript mentioned JP Morgan raising its leverage from 9 times to 10 times. Goldman Sachs moved from 10 times to 13 times. This means they are borrowing more and more. They are pushing cash into markets. That's why U.S. stocks stay afloat, even with fear swirling around. Banks know they can make money if prices go up, and they believe they can manage the risk. It's like running a casino. If fewer people cash out, you don't need much money to keep the game going. A stock costs $100. If 10,000 people want to sell, you'd need $1 million to keep the price steady. But if only 10 people want to sell, you need just $1,000 to keep the price up. Less selling means less money required to hold prices. That's why Wall Street loves low trading volumes when prices fall. It makes it easier to control the market. Even if interest rates are high, banks keep borrowing. They believe they can earn more than the cost of the loan. They are counting on the market going up. This is dangerous if things go wrong. But as long as prices rise, leverage works. The passive path sees this as a key reason the U.S. market hasn't crashed. It's not just foreign money. It's Wall Street itself pumping money into stocks. But how long? Part 6. Gold takes the stage. When trust fades, people look for safety. Lately, gold has become the safe place. For years, countries bought U.S. Treasury bonds as a safe asset. But bonds have dropped in price. Holding them has become painful. If you're China, selling U.S. bonds means taking big losses. So instead, China holds the bonds until they mature. Then they get their money back. But instead of buying new bonds, they buy gold. This shifts money out of U.S. debt and into metal. The numbers prove it. Central banks around the world have been buying gold at record levels. This isn't random. They are worried about the dollar. They are worried about America's debt. They are worried about geopolitical tensions. Gold doesn't pay interest. It just sits there. But it doesn't default. It doesn't go bankrupt. It doesn't depend on a government's promise. That's why countries like China, Russia, and even Poland are loading up on gold. They want to protect it. It can't replace everything. It's not practical for huge daily transactions. It's a store of value, not a cash flow machine. For regular investors, gold can be a good piece of a portfolio, not the whole thing. It can help balance risk, but it's not a magic bullet. The passive path believes gold makes sense as a hedge. It's like an insurance policy. You hope you never need it, but it's there if things go bad. Yet despite gold's rise, the U.S. still finds money. So how does America keep attracting cash, even as some money shifts to gold? Yet despite gold, the U.S. still. Part 7. The global lifeline, Japan and Switzerland. America keeps finding money because it borrows from other countries. For years, Japan was the biggest lender. Japan's central bank printed money and kept interest rates near zero. Japanese investors could borrow cheaply and invest in U.S. assets. This fueled Wall Street's growth. But Japan is changing. Inflation is rising there. The Bank of Japan is raising interest rates. Higher rates in Japan mean Japanese money comes home. Investors can earn more by keeping cash in Japan. This pulls money away from America. When Japanese rates rise, the yen gains strength. People who borrowed yen to buy U.S. stocks or bonds get squeezed. They have to sell U.S. assets to pay back yen loans. That's why U.S. markets sometimes drop when Japan hikes rates. So the U.S. needs a new lifeline. Switzerland is stepping in. Switzerland's central bank has lowered rates. This makes it attractive for big players to borrow Swiss francs or even dollars parked in Swiss banks. Then they use that cash to buy U.S. assets. Switzerland is small, but it holds massive amounts of wealth. People park money there because it's private and secure. Oil tycoons, Asian billionaires, European business families, Russian oligarchs, they all keep cash in Swiss vaults. This money doesn't just sit there. Banks lend it out. Some of it flows into U.S. bonds and stocks. Swiss banks can lend dollars directly. That reduces currency risks, and it keeps money flowing into America. The passive path watches this closely, because when one money source dries up, another often appears. Switzerland is becoming America's new cash pump. This helps explain why U.S. markets keep going, even as other countries pull back. Part 8: How smart investors stay calm. Running from the dollar isn't always the answer. Smart investors stay calm when everyone else panics. Warren Buffett is a good example. He holds cash when markets look crazy. He waits for prices to drop. Then he buys quality assets at discounts. This strategy sounds simple, but it's hard when fear fills the headlines. In the dot-com crash, tech stocks fell over 70%. Buffett kept his money safe. Then he bought good companies cheap. During the 2008 crisis, banks collapsed. Buffett stepped in and made deals nobody else could. He made billions when markets recovered. COVID crushed markets in March 2020. Buffett again stayed patient. Stocks roared back stronger than ever. The passive path believes in the same principle. Don't chase trends. Follow where the money goes. Track flows between bonds and stocks. Watch how currencies shift. Look at how big players position themselves. This tells you smart investors don't guess. They study data. They keep cash ready. They strike only when opportunities appear. It's not about timing the exact bottom. It's about buying good assets at fair prices and avoiding losses from emotional decisions. This approach works in North America. It works anywhere money moves. So, Part 9: Practical Strategy for Investors. Here's how to handle your money right now. First, track money flows. Look at where capital is moving. Are investors buying U.S. bonds or selling them? Are foreign currencies rising or falling against the dollar? Is gold climbing while stocks drift sideways? These clues show you where big money is heading. Second, compare bonds and stocks. If bond yields rise and prices fall, stocks might get hit next. If bonds stabilize, stocks might find support. Third, hold cash if you're unsure. Cash isn't exciting, but it gives you options. It lets you buy when others panic. Fourth, don't put all your money in one asset. Diversify. Hold some stocks, some bonds, some cash, maybe a little gold. Balance your risks. Fifth, manage your dollar exposure. If you're worried about the dollar dropping, keep part of your money in other currencies or global assets. But don't rush to dump the dollar completely. American markets are still deep and liquid. Sixth, watch leverage. If banks and funds borrow too much, markets can become unstable fast. Stay cautious when debt levels rise. Here's an example for someone in North America. A moderate portfolio might look like this: 40% in U.S. stocks, 20% in high-quality bonds, 10% in foreign stocks, 10% in cash, 10% in gold or commodities, 10% in real estate funds. Adjust these percentages to your risk level. The passive path believes staying flexible is the best defense. Keep learning. Keep reading data. Ignore hype. And move only when opportunities are clear. Join the passive path to keep growing your financial knowledge. Like the video if this helps you think differently about your money. Subscribe to stay ahead of the curve. And leave a comment with your thoughts on global money flows. because the more you learn, the better you can. So at steps part 10, closing and action steps. Today's world feels uncertain. Currencies swing. Markets rise and fall. Vague headlines warn of crashes and crises. But underneath all the noise, patterns exist. Money flows tell a story. Wall Street uses leverage to keep markets alive. Countries shift reserves from bonds to gold. New players like Switzerland step in when old sources dry up. The dollar may fall, but America still finds money. Fear drives people to safety, but opportunity waits for those who stay calm. The passive path believes in patience and discipline. Don't chase hype. Study data. Prepare for storms, but stay ready for sunshine. Investing isn't about being fearless. It's about being prepared. The next big move might come from a place nobody expects. So stay sharp. Keep your cash ready and wait for moments when the odds favor you. Join the passive path if you want to keep learning how money moves. Like this video to subscribe for future updates on global markets and investing. Comment with your thoughts on how you're planning for the months ahead. Because financial freedom isn't just a goal, it's a path. You've seen how money moves behind the headlines. You've learned how fear, leverage, and global flows shape the dollar and the markets. And you've got tools to protect and grow your wealth. If this video gave you new ideas, like it. Subscribe to the Passive Path for more insights. Comment below and share your thoughts or questions. And share this video with someone you care about. I wish you good luck on your financial journey. Feel free to check out other videos on the Passive Path.